Well, there are a few noteworthy moves in the financial markets this morning following the U.S. election result from last night that we thought might be interesting to discuss. Mostly stocks are stronger, which should on balance be positive for our mutual funds. A couple of things that we think are worth bearing in mind. First of all, this morning, U.S. stocks are higher by kind of 1% to 4%, depending on which sector we're looking at. But non-U.S. stocks, so those outside the U.S., especially in emerging markets, are either flat or down a little. Partly that's based on currency, as the U.S. dollar has strengthened. The rally in the U.S. is pretty much, we think, a response to removing some of this election uncertainty that's been floating around recently. There have been fears of delays, civil unrest, unfortunately, et cetera, around the election, as well as the fact that outside of the presidential election, the Republicans also got control of Congress, which the markets probably are seeing as business-friendly. The expectation of more America First policies, if you want to call them that, explain how a lot of this positive reaction so far today is largely in the U.S. Second point this morning involves bonds. Bond prices are down, yields are up. I think the sense here has been that a Trump administration would probably run a larger deficit, increasing the amount of Treasury debt to be issued, more supply equals lower prices, and so on. Also, the question of tariffs, stated Trump policy there, could increase inflation, which would mean that interest rates may need to stay higher for longer. We'll have to see about all this in time. Longer term, and of course this is the part that matters to us as long-term investors, the first thing, number one here, is that Donald Trump's last presidency was pretty noisy, with frequent announcements and news that markets didn't really always know how to interpret. We should really all expect that to happen again, maybe even starting right now. And this is something we think of as an opportunity for us, as well as investors, to hit the ignore button and focus exclusively on the long term. There's going to be a lot that investors need to ignore in the next while. Number two, long term, is that the Fed meets tomorrow. We're here, that'll be Thursday the 7th, and it's expected to cut its target rate again by another 25 basis points to a target range of 4.5 to 4.75. Now, inflation's been coming down. It's actually pretty close to the Fed's target of 2%, so we really should expect further rate cuts in the months ahead. Third and finally, longer term, with declining interest rates, this uncertainty now removed from financial markets in the form of the election, and pretty good ongoing economic numbers, especially in the U.S., I think long-term expectations for returns are still positive. We still have the kind of boring but usual caveats about valuations, and there are parts of the equity market that still remain quite expensive, but where we shop, we're very happy with the valuations and the prospects for the better valued holdings in our funds. So that is it from here for now.